Hey there, welcome to the Guaranteed Retirement Guy Show. My name's John, and we're going to be talking about guarantees for annuities and who actually covers you if something happens. Okay, so if you're thinking about purchasing an annuity and you're looking for the highest rates, go to my website, johnstevenson.com, and you will be able to explore all of the annuities there. And then if you'd like to, you can reach out. But let's talk about who insures these, how it works, and what happens if one of these carriers actually go down. Okay, so it does happen. It's very, very rare, but it's still good to know what is the procedure. Okay, how are my funds protected? Do I get it all back? How does that work? So we're going to talk about that. I'm going to share my screen. I'll go through some scenarios as well as far as income from some annuities. If you want to see those, I think this will be helpful. And you'll notice on all my videos, I'm always sharing my screen. I'm always showing you what these can do because the contractual guarantees are phenomenal. But let's talk about what these contractual guarantees are backed by. Well, they're backed by the insurance company. Okay, their claims paying ability. That's what they're backed by. They're not backed by the FDIC. Okay. We have similar coverages on annuities that the FDIC covers. I mean, we know right now the FDIC covers each individual bank account for up to $250,000. So if I got several bank accounts, and they're all $250 each, they'll just cover me for one of those, right? With one of those banks. So with an annuity contract, most states, not all states, but most states are at the $250,000 coverage. So what that means is if you put your money into an annuity and the company goes down, let's say they go down and you've only got, $150,000 left in your contract that they can actually salvage from the company. Okay. So you get your 150 back, but then what happens is you have the state who steps in. Okay. The State Insurance Guarantee Association, they come in and they make you whole for up to that 250 mark. Okay, so if you got 150 from the company and you still need $100,000, that's when the state steps in and gives you the rest of the money to make you whole up to that 250. Now, if you got 500 grand in, they're still only making you whole up to 250. Now, that might make you nervous and you might think, well, I've got 500 grand or I got $1 million to put into these. What about that? A lot of times people don't want to break up their contracts into separate carriers because that does make sense when you're trying to spread things out. But sometimes it doesn't make sense if you're having much, much better rates or just if you're looking for highest income or highest growth, sometimes it makes sense to leave it with one carrier. And in that case, you just have to make sure that you're researching that carrier. Okay, you got to make sure that they're highly rated. And if they're not highly rated, why? Okay, because there are some excellent companies that are B rated and B++. Okay, and they're definitely seen as more risky. And that's just because of their reserves and what they have and what they don't have as far as reserves and liabilities. There's a lot of factors that go into it. And then you got companies like NASA. NASA's been around for over 100 years, yet they're still a B++. And it's just because when you're a B++, you don't have to have as much money stored away as these other A-rated companies. A-, A+, they have more reserves. And so that allows them to give you higher rates because they're able to invest in maybe lower grade corporate bonds, okay? Maybe versus some of these other higher rated companies, they're giving you less, but they're investing in a little bit higher grade bonds. So either way, with any of these companies, you're covered up to that 250 per contract. So if you're married and you want to put in one for you and then your spouse has one for them, you could be separately covered. So that's a way to do it as well. So I want to share my screen though. I want to show you there are different coverages amounts for these states. Okay. So let's go into Google. Okay. And I'm going to show you, let's just say Nevada. Okay. Because I'm based out of Nevada, even though I serve all 50 states. So we'll say Nevada, State Guarantee Association. Okay, so we'll pull that up and you can pull up their website and I say, all right, well, what are the limits, right? I say coverage for annuities. So now we look at that and say, okay, well, it's 250. Okay, well, that's good. So you can find out that. So what about other states? You got Florida. Are they the same? 250. Although I've seen them at 300,000. Let's look at New Jersey. 500,000. Okay, so there you go. So it just depends on the state. Most states are not at 500 grand. New Jersey is, so is Connecticut. But most states are at the 250, or Florida is at 300, and it just depends on your state. And I just spoke with someone recently, and their state was moving to 500,000 from 250. So I can't remember what state that was. It's just because most states, I would say, I want to say like 46, 47 states are at the 250. So most are at that level. But I do have people that have put more than $1 million into just one company, because that company is either highly rated, they've been around for a long time, and they just feel comfortable with that. And that's fine too. Okay, you just have to realize that you got to go with your comfort level, because it is backed by the claims paying ability of the company, but then it's also backed by the state. Okay. And then on top of that, you have companies like Athene, for example, who a lot of times when companies will go out of business have been known to come in, step in, and take over. Okay. They'll take over, and the only difference you see on your statements is a logo. So there's a lot of safeguards. Okay. The industry tries to protect its name. It tries to protect its reputation, okay, for safety. And so a lot of times when a carrier is having problems, you can have other larger ones that will come in and help out and even buy them out and take over. So then you got the state, and it's just, you got a lot of rules. I mean, these companies have to have high reserve amounts, much, much higher than a bank has. A bank has only 10%. With a lot of these insurance carriers, it's dollar for dollar. Okay. So there's a lot to think about when it comes to safety. And when you're thinking about, well, who are these actually backed by? Who covers me, right? It's, John's all talking about these guarantees, right? Well, what is the guarantee backed by? Well, first it's backed by the insurance carrier. Okay. Then it's backed by the state. Okay. And then I would say, I can't say that they're backed by other insurance carriers, but there are other insurance carriers that will step in a lot of times and take over as well. So that to me is just another safety net. So anyways, if you're worried about it, just spread your contracts out. I had a lady 4 months ago. She took $2 million and she bought 8 annuities. She spread it out among 8 different companies, $250,000 each. And the rates were very, very close. And she wanted some income, she wanted some growth, and she wanted to spread out her risk. And some of these companies were A, some of them were B++. They were all good, reputable companies. They just had different reserve levels. And because of that, they have different ratings because of that. So, but they're all covered by the state, and that is what she wanted as well. So there are ways to do it and invest a lot into this and still protect yourself. Okay. There's always risk in everything that we do, but the way to mitigate it is either spread it out or look for highly rated carriers, that can take care of you. And so, and I do have people who will put all of their money into one, and that's fine too. You just have to realize with doing that, obviously you're still covered up to just that 250 mark, but then you just got to look at the carrier and who you're working with as well. And a lot of people are fine with that. I mean, I had a guy put 1.3 million into Allianz, and they've got 3 trillion in assets. He knows he's only covered up to 250, but he feels comfortable because Allianz is such a large, kind of too big to fail companies. So anyways, I hope that helps. When you're looking for annuities, you deserve safety, you deserve transparency, and you deserve the chance to be able to research on your own. So that's why I always tell people, go to my website, check out the annuities that are available, and then when you feel comfortable, reach out to me. Because obviously I sell annuities. That's how I make my money. I'd love to help you if that's what you're looking for. And if you're looking to work with me, I would love to help you. But again, that's not a sales pitch. It's just, I'm here to help if you want that help. Okay. Otherwise, check out the annuities on my website. And if you got questions, comment below. Make sure you like, subscribe, share. And I really appreciate you watching. I hope this video has been helpful, and we'll see you next time.